Stocks are in a pretty tight range ahead of the White House meeting on the debt ceiling. And my next guest says any downside volatility is an opportunity, maybe pick up some equity. But in the meantime, the short-term fixed income and money market accounts are a great place to hang out. Joining me now is Michael Yoshikami. He is the CEO of Destination Wealth Management. Michael, it's good to see you again. And is that where you've been allocating capital, relatively speaking?
We've been raising money for cash, yeah. As we rebalance portfolio strategies, we're always looking to see where we should the most opportune place to put money. And certainly with what's happening in the debt ceiling, we don't think it's time to really go out on the edge and take too much risk. However, if you have dry powder and there's an initial overreaction, which history suggests might not happen, we think there's an opportunity there to be able to move into some equities.
So, and I heard Jenny Harrington say this last hour that she's like, man, if I had just bought Lockheed Martin back in the depths of the problems a decade ago, it would have been a great name to pick up. I mean, is there a name, like a list that comes to mind with that kind of opportunity that might present itself?
Yeah, I think all the obvious names, whether it's Microsoft or Amazon or whatever, any of the obvious names, the big cap tech right now is pretty appealing. I think, given the multiples that you're trading at now. But I think just generally overall the market, there's a lot of concern about the debt ceiling. We could see a sell-off. I gave your producers some data talking about how the markets really haven't sold off in the last three debt issues. One before that, the market sold off about 15%, and that created tremendous opportunities for investors.
Yeah, so I guess the issue now is if everyone's using the playbook from last time, this time, they're waiting there, waiting for the sell-off, waiting to pick it up. Is it possible the sell-off doesn't happen? Yeah,
it's very possible. And I think, in my view, it's likely the sell-off doesn't happen.
Really?
I think this is going to be the thing about Biden. He's very much a negotiator. And so I think that even though there's a lot of positioning right now, I think in the end, if in fact they don't come to a debt agreement, they may come to a debt extension, which they've done before. And I think it's going to be very, very short-lived. I mean, when you start having Social Security checks not bouncing but not being sent out, all of a sudden the issue gets resolved. And I expect that's what's going to happen this time.
So if we don't have a pullback, then there's no need in having that list of stocks to buy on a pullback, which means you have to buy it now and chase it, or do you wait for a worsening macro, or how do you then get an entry point?
Well, first of all, I could be wrong. There might be an entry point with the market trading lower. I think that what you want to do is look at some names that you would buy, whether or not there's a pullback. In other words, good valuation names, and then try to get them at even more of a discount. And in the meantime, I heard you say in the previous segment, which I liked, what did you say? Chill and...
Oh, T-bill and chill.
T-bill and chill.
I think Goldman coined that. But by the way, it was before the bank crisis, so it doesn't seem so chill anymore.
Okay, yeah, not so chill, exactly. But, I think you're getting 4.5%, 5% on money market accounts right now. That's pretty appealing. So even if there isn't a pullback, and even if you don't have an opportunity to drop into some equity, you're still getting a 5% yield, which is not bad, even though inflation is about 5% right now.
I guess as a last question, is there anywhere you have high conviction that you would say, you're out of consensus with the market? Really, anything that you're excited about that people aren't? And we haven't really talked international. I don't know, if China, last time we checked in, you're still a little cautious.
Let's talk about it from a perspective of something that I'm particularly not excited about, which is China. I think that there still are very big structural problems in China as they convert, and people don't really get this, as they convert from an export economy to an internal consumption economy. That's going to cut GDP in half. I don't think the market's pricing that in.
In half? I mean, we did start to see this in earnings, absolutely. To your Estee Lauder, a few other names, they were stumbling, and you're going, wait a minute. Exactly. You'd think with all this pent-up demand, where'd it go? You think this transition cuts their GDP by half?
Yeah, I think in the end, over the long term, well, remember, China used to be a 10% GDP country. If they go to 4 or 5% GDP, that's great compared to the United States. But compared to China and the expectations for China, it's not so great. See, Kelly, it's about whether your economy is based on exporting goods at a cheap rate with low labor costs, or if income goes up, internal consumption. And that's where China is right now. Income is significantly higher. Therefore, they're focused more on internal consumption, which is going to naturally slow down GDP growth. And naturally, in my view, will affect the equity market as well there.
Oh, sure. And there's some disappointment, like I mentioned already, in some U.S. stocks hoping for big opportunities there. Michael, We'll leave it there. Always a pleasure. Thank you.
All right. Thanks, Cal.
Michael Yoshikami with Destination Wealth Management.